successful Vancouver exits. It's the first event of the year. Great that you're here joining us. Thank you. So for those of you who are new to this forum, to give you a bit of an idea of who we are here, VEF is the premier networking forum for technology entrepreneurs. Founded in 1988, VEF has been bringing together entrepreneurs and investors alike to cultivate meaningful connections and create conversations designed to stimulate ideas. So we host 8 events per calendar year, kicking off our season in September. We're doing things a bit differently over the past few years. These are unprecedented times, as everyone knows. My name is William Johnson. I'm a member of the VEF board of directors. I'm a local writer. I founded the Vancouver Tech Journal. Check it out. We spotlight the top tech stories and news every week in a Sunday briefing. Today, we just published a post, the smartest 20 business and tech podcasts in Vancouver. Some of you may be interested in that. Search online for it, Vancouver Tech Journal. VEF is pleased to be able to provide free and discounted tickets during this time of social distancing. We also wanted to thank the people who have generously paid to attend today's online forum, though. So thank you to all of you. If you haven't already done so, join us on Slack, introduce yourself to the Slack channel. It's great networking there. The link to join was sent out in the email we sent this afternoon and is available in the Zoom chat as well. VEF wouldn't be anything, wouldn't be possible without the contributions of the dedicated board of directors. Thank you to our board members who are committed to helping advance Vancouver's tech ecosystem. We also wanted to thank, and congratulate one of our former VEF board members, Douglas Stronsgaard. He and his team are now part of Nintendo with Nintendo's recent acquisition of Vancouver's Next Level Games. Congratulations to Douglas and the team. So we have some more community sponsors. We'd like to thank them now. Thank you to our title sponsor, Innovate BC. Innovate BC connects BC tech innovators with government support and funding and resources. I would like to take a moment to thank our other sponsors and supporters who help VEF host these events: CIBC, Corporate Recruiters, Douglas College, Fasken, Wealth Bar, Vantage Capital. Thank you to all of our partners. VEF, as many of you know, is working with New Ventures BC to deliver these online events. New Ventures is part of the BC Tech community. They offer their annual startup competition. It's one of the hottest competitions every year, as well as many accelerator programs. So thanks to New Ventures BC for helping us to execute these events every month. Big part of the Vancouver Entrepreneurs Forum are a series of lightning pitches. These happen every event. And again, you don't want to hear me talk the whole time. So we're going to get right into inviting our lightning pitch guests to speak. So these are either entrepreneurs or they're organizations. They're, the cutting edge of technology, or if they're entrepreneurs, they're leading, high growth, high potential early stage companies. Each one of them gets 100 seconds to promote their venture or their initiative. And today we have 4 pitches today. And up first, we've got Irene with Angel Forum. So I'm gonna pass it off to Irene right away, actually, for her lightning pitch. Irene, are you there?
Yes, of course I'm here. Could I share my screen? I just have a one slide.
Yeah, I think you should be able to share.
I can't while others are sharing, but that's okay. I can do without too.
Oh no. Let's make sure you get to show what you're looking to share.
Thank you. Thank you so much. It works. Awesome. So, can you all see this? There we go. Can you see my screen?
Looks good.
Good. So shall I start?
Your 100 seconds starts now.
I can do it in less. My name is Irene. I'm with the Angel Forum here in Vancouver. And for those of you that do not know, Angel Forum connects promising early stage tech companies with accredited angel capital. And we do that through the organization of events, summits, webinars, workshops, you name it. We almost do it all. We do that together with other organizations all over the province very often, so that makes it even better. Membership for Angel Forum is open to accredited investors, and companies that are interested in presenting to raise capital can apply for a spot through our website. My website is there, and my email. If this particular meeting gets you really excited, tonight's meeting with VEF on exits, we have a webinar on exits this coming Thursday with David Raffa, who will share with us the basically how to execute and plan a successful exit, and we would love to see you there. If you register through our website, if you use the code that's on the screen, VEF, there's a 50% discount. And that's all I had to say. If you have questions about membership, presenting, or webinars, my email is there as well, and I look forward to hearing from you. Thank you so much for the opportunity, and I think it's good to see VEF back like this. Awesome. Thanks, William.
Thanks, Irene. Really appreciate that. Perfect. Up next for our lightning pitches, we have Nicola Alavoyevich from Innovate BC.
Hi there, just a minute trying to get my screen up. Good job pronouncing my name well. So hi guys, I'm Nicola from Innovate BC. I'm the Marketing and Events Coordinator. If you haven't heard of us, we're a Crown agency and we work with companies across all sectors all over the province. What we do is we deliver programs that help entrepreneurs start and scale their companies, as well as addressing the biggest pain points of BC businesses. So Innovate BC offers 10 programs that are available to small and medium-sized companies, as well as entrepreneurs and researchers. And they fall into 3 broad categories, and that's business coaching, hiring grants, and funding opportunities. But in the wake of everything that's happened this past year, we've applied a recovery and resiliency lens to our services. So we added support for Main Street businesses and focused on building digital skills in underrepresented groups. Innovate BC also runs virtual events for the BC tech community. These range from live Q&A sessions with industry leaders to exclusive masterclasses for our program participants. Essentially, we're helping innovators across the province build great companies, and we want to hear from you and learn what we can do to help you. So if you're interested in anything I've mentioned, you can learn more at innovatebc.ca. Or feel free to reach out to me with any questions. You can reach me at marketing@innovatebc.ca. And if you want to keep up to date with what we're doing, you can follow us on social media at innovate_BC. Thanks.
Thanks a lot, Nicole. Up next, we have someone you all know, Dave Thomas with SFU Venture Labs. Dave, are you there?
I am. I'm just gonna figure out one thing and I'll be right with you. So I'm with Venture Labs. I think I know some of you know me from being a participant or from Rocket Builders as well. And I'm here just trying to recover the presentation I had that I was going to show you very briefly. In any case, I'm here to talk about the other end of the spectrum, which is very early stage companies. Venture Labs is going to provide or run a market validation training program in conjunction with New Ventures BC. It's something that we've done in the past. We're going to run a 4-session program for early stage companies that are interested in getting into the marketplace. It is something that we will do in the next month and a half. It will start on February 22nd. And if we could, I'd like to, as I said, it will be a 4-session market validation training program. It includes mentorship and coaching from executive and residences from Venture Labs, New Ventures BC. And it will also include a review at the end and a potential for additional ongoing support from Venture Labs and New Ventures BC once companies finish everything that they're doing with this. Topics that included are goal setting, customer discovery, market targeting, customer analysis and digital marketing, and then developing the basis of a go-to-market plan, including pro formas. So if anybody's interested, the Venture Labs website has a form where you can register and put your hand up for market validation training, and we hope to hear from you. Thank you very much.
Thanks a lot, Dave. Love to hear what's going on at Venture Labs. Some wonderful stuff. Next up, we have Abby Sheck Aurora from We Do Laundry. Abby, are you there?
Yes, hi, William, I'm here. I'll just share my screen.
Great.
Let me know
Perfect.
when I can start.
Yeah,
Okay.
go for it.
Okay. Hey guys, I'm Abhishek. I'm the CEO and co-founder of the company called We Do Laundry. And as the name says, we are solving the problem of dirty laundry. This is how our business model works. We serve in every city of Lower Mainland, and we have recently started in Toronto as well. We contract with different laundromats around the city, and we have drivers to do the logistics to pick up the laundry and deliver it to the washer for washing and folding, and then deliver it back to the customer. We are looking for more growth, and we are looking for $250,000 of growth capital to add more customers into our customer base. We are currently having 1,250 customers with 25,000 of monthly revenues, and we are looking to increase our revenues to $100,000 by the end of this year. And this is how the opportunity is for the investors for our company. Thank you.
Nice, Abhi. Short and sweet. You had a strong ask in there. 250,000 in seed capital. Glad that you had the ask in the PowerPoint there, so everyone listening knows what you want. Thanks for that pitch. Let's just see here. Perfect. Now it's time for me to share my screen again, folks. Just give me 1 minute. Perfect. Everyone can see the lightning pitches slide, right? Good. I see nods. Perfect. Let's get social. Thank you to everyone who provided a lightning pitch. I'd like to remind our guests today to keep the conversation going on social media. You can connect with us on Facebook, LinkedIn, or on Twitter. And with all those introductory remarks and pitches done, I'd like to get us onto our panel. Looking really forward to this one, M&A in uncertain times. And so to get us started, I'm going to introduce our moderator for the evening, Maria Pacella, the managing partner of Pender Ventures. Maria has over 20 years of investing and operational experience in emerging growth companies with a focus on technology businesses. She spent 11 years with one of Canada's largest VC firms, where she invested in multiple early stage companies and served in a variety of boards in the areas of enterprise software and health tech. Along the way, she's worked at a couple startups, assisting with operational activities and strategic initiatives. Prior to that, Maria worked in M&A for Deutsche Bank. Current board roles include Clarius Mobile Health, which is doing some really neat stuff around portable devices to help rural and remote communities access healthcare. She's on the board of Jane Software. Terry Dici, which just came out with some exciting news today. LibraStream, 145 Software, and Tantalus Labs. She's on the SFU BD School Business Advisory Board and the St. Paul's Hospital Foundation. She holds a BBA from Simon Fraser University and is a CFA charter holder and an active member and past president of the CFA Society of Vancouver. I'm safe to say that everyone this evening is in very good hands. And so welcome, Maria, and then I'll let you kick stuff off for tonight's panel. Welcome, Maria.
All right. Thanks so much, William. Very excited about today's panel. I think we have some great panelists with some very different stories to share. So let me tell you a little bit about them first. So first off, we have Graham Manders, who's the CTO and co-founder of DarkVision. He is an entrepreneur who has survived, yes, that's right, survived 2 companies with 2 exits and has spent 15 years building companies. Graham loves new technology and diving into unfamiliar spaces. Pragmatic, though often unconventional inventor, Graham loves to inspire new solutions to old problems in order to build value in industries often ignored by the crowd. No stranger to recruiting, designing, pitching, researching, and coding, Graham wears many hats and believes in doing anything and everything needed to get a startup off the ground. We know that very well. DarkVision was acquired by Coke in May of 2020. Keith Marett, who's also joining us this evening, has more than 20 years of experience growing companies on a global scale. As CEO of Nurio, Keith oversaw the growth and development of the team, which led to the successful acquisition by Generac Power Systems in early 2019. During his 5 years at Nurio, the company grew from pre-revenue stage to just over 200,000 energy management systems deployed globally. I'm guessing that's millions of dollars. Within that time, the company has been recognized numerous times for its achievements, including being ranked as one of the fastest growing companies in Canada in 2016 as part of the Deloitte Fast 50. Prior to Nurio, Keith led the market and product development strategy for Avigilon, a well-known local leader here in security products, and helped grow the market cap from 90 million to over 1.3 billion in just under 3 years. No small feat. Prior to Avigilon, he held numerous senior positions at Bell Canada. And third, but not least, Nicola, who is passionate about personal finance and wants to help people understand how small changes can make a big difference. Originally a mechanical engineer, I'm guessing still a mechanical engineer, she later spent years working as a financial advisor and advisor trainer. Taya co-founded WealthBar, a Canadian full-service online financial advisor, recently acquired by CI Direct Investing in over a number of years. So to sort of set the stage, I thought I would talk a bit about what's going on in the M&A market, which is obviously quite important. So I'm just going to point you to a recent M&A report by Valeo Capital Partners, actually from David Raffa, who you heard from Irene's pitch earlier. He released a report last week that dove into some general M&A numbers, but also M&A numbers for here in BC. So despite, really tough year all around, to say the least, last year due to the pandemic and the economic slowdown, there were actually a lot of very large deals that closed around the world, really. To name a few, NVIDIA purchased ARM for about $40 billion. Salesforce, as we know, is purchasing Slack for over $27 billion. Morgan Stanley bought E-Trade for $13 billion. And the NASDAQ is buying St. John's Verifin for $2.75 billion. Closer to home, there's been over 40 exits in BC last year. To name a few that you may, I'm sure, know of, Lender Spotlight by Lendesk, Lead Pages by Redbrick, DarkVision Tech by Coke Engineered Solutions, which you'll hear about tonight, Secura by Wealth Health, and finally Mobify by Salesforce, just to name a few. So 40 exits in BC last year. Quite a good number considering everything. So I thought to kick off the panel, it would be great if the panelists can each tell us a bit about the company they founded and also a short elevator pitch on the company that acquired you. So with that, maybe Taya can kick us off.
Yeah, absolutely. I founded a company that tried to close the gap between the way that, wealthy people save money or the quality of advice that they get and the way that mass affluent market, which are focused on the banks and the services the banks provide, receive financial advice and really close that gap. We talked a lot about accredited investors tonight, and if you don't live in that world, you aren't necessarily aware what goes on in the offices of advisors who cater to high net worth investors. And I attempted to use technology to lower that minimum of $1 million, but maintain the integrity in the professionalism, maintain the integrity in the advice, and the quality of the investments. That was the original purpose of Wealth Farm. The elevator pitch, we were acquired by CI Financial, who is Canada's largest independent asset manager. They're a publicly traded company. They've been around since the 60s. They've really reinvented themselves in the 90s. So what are they really independent of? Well, they're independent of the big banks. They are still largely owned by the founder family and his partner's family, and have maintained sort of that a little bit of that startup-like culture that, you know, they're not a transnational corporation, and they're very much, you know, led still by that unified direction of an entrepreneur.
Great. Graham?
Sure. Yeah, so I founded DarkVision back in 2014. We were really setting out to build, you know, we had a machine vision background. We were trying to kind of come up with some industrial imaging system for, you know, a new industry, something we weren't familiar with, something new, something exciting. And that's a long story, but what we ended up developing was an ultrasonic imaging system, a whole platform for inspecting wells. So you can think of this as a medical ultrasound system that that is packaged in a way that allows it to go deep underground at super high pressures and temperatures. But along the way, we built all the hardware, all the electronics, all the firmware, all the software, whole visualization platform, and that kind of led to, you know, the path we're on now, which is you know, exploring a number of new markets, and we're right now just starting development on 2 brand new product lines that incorporate all our existing technology but apply it to different areas. As far as Coke, you know, I think a lot of people have heard of Coke, but most people don't know much about them. They have 130,000 employees globally. They operate in 70 countries. They are one of the world's largest private companies. And some brands you might not realize are Coke brands are Georgia Pacific, you know, all the pulp and paper, everything that comes from GP. Molex, big electronics company. So, you know, traditionally they were involved with petrochemicals, but they've kind of gone into glass, into electronics, into robotics, into all these tech sectors. So we kind of fit well into that, and that we're a technology company. They're looking for high growth tech investments, but they're also, we're also kind of, we can serve a lot of their existing industrial infrastructure. So they're a great partner for us for that reason.
Thanks. And Keith? Are you there, Keith?
Yeah, sorry. So actually, unlike the others, I'm not the founder of what was Nereo Technology. I joined in 2014 to really head up their marketing and business development as an early stage company and trying to, you know, get to market, and took over as CEO in late 2017. So I guess, you know, what Nereo is an energy management company where we make both the hardware, the firmware, and software that basically helps manage the home's electricity. Predominantly in the renewable space is where we play, so solar homes. When you think about companies like Tesla, what they have with their solar tiles and solar roof, and the power walls that store the power, that's where we play. So that's the market we play in. Yeah, I mean, I guess a little bit about Generac. So in 2019, we were acquired by, in I guess mid 2019, we were acquired by Generac, and it was actually a company I'd never heard of before, which is kind of surprising. It was one of those out of the blue things. So they are a large natural gas generator company, is kind of what they pride themselves on. that provides backup power to both residences, commercial buildings, CNI, you name it, is really where they play. They've got about 2 million residential standby generators at homes. You think about when hurricanes come through or power outages that we see in California, they're there to back it up. So everything from residences to hospitals is where they play. And with the change is what's happening in the world, in the industry, especially around climate change. The executive team there had foresight to think about expanding beyond just natural gas and look at more renewable technology. So the solar and lithium-ion battery backup stage is what they looked at. And where Nereo fit in is the software energy data platform that ties all of the components together. And so we were a key piece to that. Literally a month after they acquired us, they acquired another company in Portland, Maine that built the actual batteries and inverters, and we combined it underneath the two groups underneath one business unit, which we call now the Clean Energy Business Group. And then we just finished an incredible year with about a 10x over 2019. So pretty big year for us.
Oh, terrific. All right. So Keith, given you're off mute, I'll start with you, but it would be great if we can hear from each of you a bit of a snapshot, Cole's Note timeline of the acquisition itself. So from when the acquisition talks perhaps started through to signing of the final papers and any kind of key events or milestones that happened in between. So Keith?
Sure. So I guess, I got a phone call from their CEO, or I guess it was an email, sorry, from their CEO. I don't want to say October-ish of 2018, just giving a heads up of who Generac was and wanted to get a little bit of information about who Nereo was. They'd heard about us in the space and were interested in adding energy monitoring and management to their existing product line, which was great because it looked like a really big commercial contract that could be possible. They were talking about millions of units, which would be big. So I met with them at an industry trade show with that year, kind of went down the path of commercial relationship and partnerships. They offered it for us to come out there, so I took my executive team out there to Wisconsin later in I guess November-ish to more how about those commercial relationship discussions. Quickly they were asking if we were looking at raising money or capital at the time, which we weren't, because we're actually having a very profitable year, but we were planning in the next year to do this. So, and so we kind of kept them on our radar for that. And then towards the end of the year, I'd say those discussions really ramped up about, their intentions and what they wanted to do. And so again, the CEO flew back out for a dinner visit with myself and my chairman. And so they wanted to acquire the company. We got the term sheet in early January. And they, through some pretty fast negotiations, were able to nail down the term sheet by, I'd say, towards the end of January. And we were closed on March 13th. So it was incredibly rapid from when we signed a term sheet to when we closed, which I guess, it goes back to one of my big things of advice is, make sure that you've got a good, a really strong deal team formed. I had the privilege of working with, I'd say, probably one of the top chairmen in Vancouver right here, David Sutcliffe. He was just an absolute, privilege to work with. He helped, mentor me in the process, knew the process, worked well. I had a great M&A team through the advisors that we brought on board, and then all the way to the Faskins legal team, Ian Mant and John Conlon. I couldn't have done a deal without them.
Oh, great. So it sounded almost preemptive, and it didn't sound like you went out to market with two others.
No, we were we were not out to market. It was right out of left field. I mean, because I just became the CEO just the year prior, it was really, I brought up a new executive team. I put a whole new board in place. Some key executives in town from Greg Malpass at Traction to Norm Francis, and Judy Hess. It was really about, scaling this thing, and M&A was not even thought of on the radar.
Okay, great, thanks. Graham.
There we go, unmuted. So for us, it's kind of maybe a little bit longer of a process. We started summer 2019. We were kind of working on raising our Series B, looking to kind of grow our revenue, scale our operation. And we'd talking to a number of groups at the time. But Coke, very quickly became maybe our favorite in that discussion. But the thing with them is they're really looking for something more. They didn't necessarily want to invest, be a minority shareholder in something. They want to be able to put a lot of resources into a company. So that discussion, starting in summer 2019, morphed into an acquisition, or really a partial acquisition. So the way our deal was structured is all our existing investors, our existing VCs, they fully exited. But we weren't ready to sell the company. We were trying to raise a Series B. We weren't really planning on selling. So it kind of became a compromise where, they bought out a portion of our shares, but we kept a majority of what we owned. The founders and all the early employees. So we ended up with a nice compromise there, and I think our term sheet was signed mid-March. And then it took us till May, middle of May to actually close. So it was a long process, obviously with some excitement along the way. Yeah.
Great. All right. Thanks. Taya.
So our story was a little bit, well, they're all different. So we're all snowflakes. So we didn't really have an intention on selling, but I was looking for a large commercial partner. And we had gone through a 6 weeks due diligence already with one of the major insurance carriers in Canada, to be their technology platform, but this was just a purely commercial, and we needed something like that to kind of propel the company to the next level. In the meantime, our main service provider, BBS Securities, was purchased by CI Financial in December of 2017. And this is, and at the time when CI purchased BBS, we were like 35% of BBS's business. And so they had insight into a lot of what, the flow and the stuff and what we were doing. So I met with the CTO at the time and the head of one of the private wealth in April of 2018 for a very informal conversation, again, to be the service provider to these technology companies, whether it's my Naivet or they were just, but that was basically where these conversations were going or how they were starting in my world. And in June of 2018, I was invited for a coffee by the CEO of CI Financial to meet me because we share a very mutual acquaintance, and we were introduced by that mutual acquaintance in Howard Atkinson earlier that month. And I happened to be in Toronto, and I purely thought this was a meet and greet. I showed up ready to have a coffee and a chat and was pulled into a boardroom with 8 people. And I was like, this is not a coffee. So it was a nice conversation, and we had a conversation. And at that conversation, they told me that they would like to either invest majorities, invest money into Wellfire and have them own the majority, or buy us outright, and whether or not I was open to that. And, every CEO, I pull out my Trump card, because I'm not going to answer that on the spot and say, well, I'm going to go to my board and talk to my board about it. And so we went back and we scrambled to get the advice. We had a board meeting, we had an advisory meeting. We hired a M&A team out of Toronto so that we would BMO. I had relationship with that team, but also because I needed insight into the buyers as well, because it was such a David and Goliath marketplace that I needed somebody sort of who understood that world on my behalf, on my team a little bit. And then in August 2018, we agreed to start conversations about selling to CI Financial and open those discussions. We did not promise them exclusivity, but we also didn't go to market in any significant way. We were relatively market aware and who the buyers could potentially be, and we were approached even before CI by a few of them and kind of knew where they stood. So we, had a couple of phone calls after that and checked some interest, but there was no formal going to market. And there was definitely, we did not try to stir competition. What was important to us that we would get funding and that we would be able to continue the company. So we were given a term sheet in at August 2018, and most of the negotiation happened between the way that we were given the term sheet and the day that the LOI was signed, which was November 15th. And after the LOI was signed, we spent another 3.5 weeks hammering out the share purchase agreement and the term sheet for the shareholders agreement. And when that was done, we announced the deal. And then we went through finalizing the documents and seeking regulatory approval, and the deal closed on January 23rd, 2019. But in everyone's minds, it was, even for tax purposes in some cases, it was December 18th, 2018.
Okay, thanks. And so was there sort of implications from the business side, sort of doing that step function where they bought, majority and then the whole?
So, every deal is, sometimes a deal is structured with 100% acquisition and then, an earn out and some kind of employment agreement for the founders. But usually, and we all know the story, when a behemoth like that approaches, a nimble company like us, they don't know really what to do with us. It's kind of like Hulk getting a tiny little pet. And so they needed to keep us invested in order to, propel and integrate the company properly. So this is just the way that we chose to structure the deal. It could have been 100% with an earnout. It wouldn't have really mattered. I don't think that we should perceive this in any other way. There was no staging intentions, but it was for that. They needed us to be invested enough in the deal in order to maintain the sidecar strategy that they originally intended for us.
Okay, great. Thank you. So Graham, I'm not gonna let you get away with not sharing a bit more of the story if you can and feel comfortable. I know there was lots of stuff that went on in the last bit, and I think both Keith and Taya mentioned it a little bit about the deal team and the importance of that. So it'd also be great if you can let us know sort of how that came together, either internally or if you had any external help as well.
Yeah, I got to be a little bit careful with what I share and I don't share. But yes, it is an interesting story. I mean, the biggest thing for us was we went into this, things were going awesome, and we had 700% growth between 2018 and 2019, or 2019 was phenomenal. Things were looking awesome. But then as we're signing the term sheet, the stock market's crashing, the world's falling apart. And of course, yeah, with COVID and everything else, and then, you know, negative oil prices and everything along the way, led to a lot of extra stress and excitement and a lot of questions from them. But to their credit, you know, they never tried to renegotiate on anything. They stuck to their word. They signed that term sheet and they went ahead with it. So it was an exciting time, but we were very very fortunate. In terms of, you know, our CEO negotiated pretty much everything directly. Fasken was a great asset to us. I think Keith already mentioned John Conlon. John Conlon was our go-to at Fasken as well, and he did a ton of great work for us. Our chairman, Jonathan Bixby, was involved a lot as well. So yeah, it was very much a, you know, direct negotiation discussion with them, and yeah, that you know, like I said, it took longer. And Generac closed quickly. I don't know how they did that exactly, but for us, it took a little longer. Especially things moved a little slower, and it felt like forever when the, you know, the world was falling into this pandemic. So, but yeah, it all worked out in the end.
Great. Okay. So Graham, and also I'll come back to the rest of you. Can you share with us sort of what were the important financial metrics that the buyer, that in Coke in your case, looked at? You know, margins, all that kind of thing, that were key for you. And I know it's three different businesses, but it'd be great to hear about the financial side, what was important to the buyer.
Yeah, so I think, you know, I don't think they really wanted to get involved with things that are too early stage. And we had our first revenue in 2017, and our growth was phenomenal, right? We went, you know, I think a 4x and then a 7x or something, and the trajectory was really, really good. So that was huge importance to them, because they could see that we would be self-funded pretty quickly. The other aspect was, yeah, of course, our margins are close to 90%, or I think, or something. So it's a very good business in that regard, and that was quite attractive to them. But there's also a strategic aspect for them, because they have all this industrial infrastructure, and, you know, we can be somebody that can supply our services to a whole host of different industries that they're involved with. So those aspects definitely played into it.
Okay, Keith.
Yeah, I would think ours was a bit unique, where we actually decoupled our own personal finance metrics from the terms of the deal itself, because we were exiting to a strategic where they were really looking at us for technology and the people that built the technology. We surrounded everything around that, and that's how we determined valuation and how important is, you know, our tech and people to Generac's business. And so that, I think, helped out a lot. It's ironic enough, because like right in the middle, you know, we started obviously with the financial metrics, and then kind of like right at the beginning, all of a sudden some customer POs started getting canceled and moved around, and so it was causing some concerns. But ultimately, because we stuck it on technology and people, it didn't change any of the deal terms. And in fact, as soon as we closed the deal, within a month of closing the deal, they asked me to cancel all of our customer contracts except one with a big company. So it really has not been on revenue. It's or profit or anything like that. It's purely been on how can we help propel their business.
Okay. And did you actually get into sort of building that business case in the discussions for them to help them get there?
Yeah, I mean, a little bit. I mean, they've got, because they didn't, this is the first acquisition they've done that's like a true technology startup. So they didn't really understand, how do they value a startup? Do you value it like, is it $1 million per person, or, you know, they didn't really understand that. And so we kind of had to walk them through a process of how important it could be to their business. And that's why I said, like, you know, I think the value really does come through experience and having someone like, you know, David and I in the room. And then the other thing I would say was really critical to ours, because again, it was, you know, we were Generac wanted to move so fast, and ironically enough, now I'm working there for almost 2 years now. They just move fast. That's generally they just generally do. They're not a sleepy Midwestern company, which we all kind of perceive Midwestern companies. But they, so, you know, they wanted to move fast, which worked well for us. And, you know, good advice that I would received is kill the deal as fast as you can, as early as you can. So if there are, you know, if it's revenue that they're hung up on, something happens and that kills the deal, that kills the deal. If there's a skeleton in your closet around technology and that kills the deal, that, you know, that's what it is. But the advice is, you know, that I received was kill the deal as fast as you can if the deal is going to be killed, rather than stretching out and finding out the last minute and after you've tied up your whole executive team working on a deal that doesn't come to fruition, and all of a sudden now your business is impacted by that time. So yeah.
Okay, great. And Taya, any key financial metrics or other metrics, strategic or otherwise, that CI was really looking for?
I think CI was looking for my experience and expertise on what this vertical of wealth management looked like from a business model perspective, and whether or not I had a history of succeeding with that theory. So it was basically a little bit looking back and then a little bit looking, but what if we look back and then with our resources and opportunity inside CI, such as Asante, what can we do with this business going forward? It was more of so it was a combination of strategic thinking and a financial thinking. And it was definitely negotiated by me and my co-founder and my husband, Chris, but we did have a relatively heavyweight advisory team. We had, you know, 3 or 4 lawyers in different expertise from Osler, and we did have this M&A team, and they did advise us and prep us for these negotiations, and in certain cases kind of move the plot forward, if you will. But they were absolutely invaluable, and but we did most of our negotiation ourselves as well because of the nature of what they needed me to do. So it was almost like, you know, a 2-month-long pitch. So we would go through these, you know, it's like the biggest pitch I ever received was going through these business model projections with the president of CI and seeing if we could kind of make this work. And I will actually second that deal breaker advice, kill the deal as fast as possible, and expose everything that is. And so I actually have, now that, you know, not that I'm an expert, but I have sold a company and bought a company myself. It's, I have modicum of a process, if you will. And that is one of the things that I have very early on. It's called the deal breaker conversations. I usually air out my skeletons in the closet right away and ask for what I would deem deal breakers, if they have those skeletons that I would deem deal breakers, and ask for the transparency and honesty. Obviously, if they aren't transparent and honest, like we can deal with that later, but I have that conversation, at least open up a space very early on.
Great, okay. Yes, we'll definitely come back to that point. So perhaps going back to Keith for a moment, can you talk about, you were able to close this relatively quickly with, you know, a large NYC, I think, listed company. Any hiccups along the way? Any advice on the prep, besides obviously getting a good deal team, but, you know, ahead of time?
Yeah, I mean, there's always gonna be hiccups along the way for sure. Even though like our deal, you know, was closed in 45 days or something crazy, some fast time frame. But I guess the biggest advice that I would have, and this was told me earlier on in my career, was is treat your company like a public company, even though it's not. And, you know, don't put all the crazy, you know, if you're going to be, you know, U.S. public company, Sarbanes-Oxley, all that crazy stuff and SEC compliance, but like, you know, make sure that your cap table is clean and make sure that You've got proper financial records and ideally professionally audited statements, and all your employment agreements are in place, including yourself as the CEO, which I don't know if a lot of people don't have that. So make sure all of the stuff is ready, and in ahead of time, understand what your skeletons are and how to counter them. There's always, especially in a tech company, there's always going to be tech debt they're going to have to deal with and understand. Make sure you understand that and have a game plan to how to address it. If you have employees that, are going to be on the way out or are planning on the way out, make sure you deal with that ahead of time before going into the discussions. It's really makes it for a smoother process, I guess would be my advice. You're less fumbling, you come across a little bit more professional, especially if you're dealing with a company that's like with Generac size, they have a whole M&A team. Like they had an army of people to deal with. And it was just like, myself, my financial person, and, a bunch of others. So it's more organized ahead of time, the better.
Right. Yes. I mean, as an investor myself, I really tell all of our companies, kind of act like you're always for sale or always looking for money, as the case might be. And Graham, over to you, where I know that you guys are maybe thinking about raising money. So, whether it's just having a data room always sort of up to date and ready to go. In any other advice on the prep side?
For me, prep side, no, I agree with everything they're saying. I mean, you really having everything organized and having all your material together, all your financials sorted, all your contracts, all your NDAs, even just silly stuff can raise a bunch of issues in due diligence. Random projects you've done with certain companies or universities or whatever else. If you don't have the right paperwork and together, it's going to it won't necessarily kill anything, but it's going to slow stuff down. And I definitely learned, you want to close quickly. I mean, Nerio closed very quickly. I think that's always the right approach. It took longer for us, and maybe there's things we could have done to do it faster. Obviously, in the end, it all worked out, but you never know what's going to happen. Like you might have a pandemic hit you in the middle of your negotiation, and things can get scary. So definitely, if you have everything organized, you can close quicker, and less will come up in due diligence for sure.
Yeah, I guess that's going to be on the list of risks going forward.
Yeah, exactly.
So Taya, so let's maybe switch to what's happening post the transaction. So I think, Taya, that you and your co-founder are no longer with CI.
Nope. Yep, you're correct.
So you can tell us a bit about that announcement.
So when we created this, deal and we had a 75%, there was a different CEO at the head of CI and a different president, and it was a different, senior management. And I remember at the time having a conversation with them, and they were, getting, this was, later in the process, and I was kind of defending my cynicism, if you will, in the negotiation by saying that it's not personal. I am negotiating because I'm going to have to potentially deal with somebody else and not them. And then, just as a matter of argument, neither of them really thought that this was going to happen. And then very shortly thereafter, ancillary trigger happened, and the board made a decision to go in a bit of a different direction, and then the CEO resigned and the president retired, and we appointed the new CEO who would like to unify CI Financial in the way that it hasn't been done to this point, and it wasn't dealt with. It wasn't, they carried many brands. They existed as CI Financial, but now they want to unify all of their brands into the CI umbrella, and there will be more so like departments than they will like subsidiaries, especially subsidiaries that carry the brand. And with COVID and with all of that situation, there was just an opportunity in our agreement, in our strategy, in the moment for us to part ways, and in a way that I, can't get into right now. It was kind of the best for everybody, the best for the business and the best for us. They integrated a lot of the functional things that Christopher and I did at 12 Bar, like I did strategy. So as if CEO is unifying the entire company, he's responsible for the strategy. So I didn't have to do that anymore. I don't have to raise money. I don't have to look for partnerships. So there was a lot of things off my plate from a CEO perspective. And then I was a bit of an odd man out. I was the only other CEO in CI. No one else had that title. So there was just a little bit of, cleanup, operational cleanup that they did. And it was an opportune time. And yeah, that happened December 31st. And that was our last day. So it's been 3 weeks retired, if you will, for now.
Yeah. Oh, for now. Interesting.
For now.
Yeah. Excellent. So just a reminder, if you have any questions, please post them in the chat and I'll try to keep an eye out. So Keith, I think I heard you say they wanted you to cancel all the customer contracts right after the acquisition. So how did that go?
Yeah, tough, especially, it was funny, obviously tough for the customers because we've been, working on solutions that they were sort of integral to their, business plans going forward. So that was tough for them. But surprisingly enough, it was actually really tough on our internal people. So they were, they had vested time, vested interest in these projects, spent some of them years working on to get them built up. And so some of the engineers, the sales team were quite disappointed to see us cancel some of those contracts that we've been so, working hard to get. But, I think with any typical startup mentality, it's on to the next great thing and, adapt and change. And because of what, the ambitions and growth plans of what Generac was doing, that really helped with the transition for the team. And the growth since then, we've added 50% to our staff last year, and we'll add another 50% this year at least. So it's not like there's a lack of projects. It's actually quite the opposite. There's a lot of big stuff going on right now. So yeah, I think that's good.
Okay. And
weird. The only weird thing for me personally, I guess, would be is it's a bit of a weird thing to go from being a profit center, so you're out to make profit, to a cost center. It's just a different change of mentality where now I just have to look at how much money I lose every month, and then go ask dad for money to pay for it all. Like it's a bit weird.
wow. Yeah, I could imagine. Does that have an impact on the team and the dynamics, or how that gets translated?
They don't see that stuff. No. I just go to the Generac finance and we put together a cash flow plan of what we need for the business for our side of it going forward, and we go there.
It doesn't change their goals and all of that.
No.
So how so obviously this kind of, the buyer came out of the blue a little bit, and you moved quickly, but what made you decide not to sort of start a general M&A process and look to see who else was out there?
Good question. I think, the more we got to know Generac, which was a very short period of time, which goes a little bit against my normal advice to people, to startups who are looking to sell their company, which is normally like crawl, walk, run, which is, first start with a commercial relationship, then move into maybe an investment to get to know each other. And then, as you get to run an acquisition as part of it, like 100%. We skipped all of those steps and went to acquisition. And so we had a very short amount of time to get to know who they were. Really like the CEO, really like the CMO, who's effectively my new boss, and their vision and their growth plans and what they're wanting to do. I mean, you can see it by the Generac stock increased 5 or so X, I think even more than that since they acquired us. So there's hugely ambitious company, which aligns well to our culture. And, you know, frankly, they gave us an offer we couldn't refuse.
That helps.
Yeah.
Okay, great. Back over to Graham. Can you tell us a bit more about the structure, the partial acquisition? And I think you said you didn't use an investment banker. Is that right?
No. The structure, there's not much else to add. I mean, basically they bought a portion of our shares, and they'll buy the you know, kind of a program, a structure in place to value the company and buy out the rest of the shares if we choose to sell them in this sort of 5-year timeline. So it's a great deal. It requires some trust from them for sure. Like we have to trust each other, but it's a great deal in that we're perfectly aligned, right? We have the same goal, which is to build value for DarkVision and build this into a much bigger entity than it is today. And it allows us to retain and continue to motivate all of our employees in the same way, right? So I think it's really going to help us. You see a lot of startups, they kind of get smothered by Big Brother, or they're never the same after acquisition. And I think, you know, we're managing to avoid most of that, and part of that is the deal structure for sure.
Okay. So talking a bit more on the topic of the people, like culture, it'd be great to hear from all of you. I'll start with you, Graham, again, because you're not off mute. You know, how did that go? Pre-deal, even sort of making sure incentives are aligned to post-deal, right? Because I'm sure a big part is the people for the buyer as well in those situations. Can you talk a bit about key learnings there?
Yeah. So Coke, I mean, they're sort of this Midwestern company, and people are very down to earth and sort of practical and easy to get along with. I don't think there's a single person that we've had some sort of, you know, found frustrating to deal with. You know, so that was very clear from the get-go that this is like a great group of people to work with. And you know, even though it's a huge company, because it's a private company, there's a lot of power in the hands of a few people where we don't actually dealing with that many people. You know, they don't have this huge team that we're interfacing with. We're interfacing with a handful of people, and we've been able to build good relationships with them, for sure. And they told us post-acquisition, like a big part of, you know, going through with this was you as the founders and your company and your culture, and making sure that we think you can kind of fit into everything we do. And yeah, I think we found that it's a good relationship so far.
Excellent, thank you. Some great questions coming in here. So maybe turning to Taya. So now, given what you know now, is there anything you would do differently in the early days that perhaps you would have led you to do the M&A differently or faster, or gone to a wider group, you know, et cetera?
Sure. I mean, there's probably things that I can think of that I could have done differently, but I'm relatively happy with the way that things worked out. And I, you know, again, have a process where I, you know, surround myself with people that can give me advice. I ask a lot of questions. I'm an engineer, and I kind of approach every problem with like, figure out what your current state is, what are the facts at hand, what are the, you know, laws of nature that are governing this particular problem, and then what's the best way forward. And I do everything I do like that. I raise my children, you know, everything I approach is that way. I gather as much information as I can, and then I make a decision. And I'm usually, you know, in life and in business, 99.99% of the time, totally content with my decision, even if I don't like it, it's not the best outcome and anything like that. So I guess my one, this seems to be a little out there, but my one piece of advice is make a process for a lot of things that you do, and then just follow the process, and the process takes care of it. It's something I learned long time ago from an old insurance salesman in a quote: if you have a problem, make it a procedure and it won't be a problem anymore. And if you think about it, everything can actually be not necessarily solved that way, but at least approached that way. And a lot of things that we do, we've approached that way and learned through the process to improve it, but are always happy with the final outcome and are kind of content. I don't regret things in life. And so, yeah, sure, there's some things that, I could have, held my ground on point A or conceded on point B, or, did it faster or did it sooner. But these are the things that are ups and downs. And even if I bring them to light and say what I would have done differently, anybody who goes through this process again would have had different ups and downs, and it would have been just, completely different. So, I don't have a silver bullet of like, oh, if I had just known that. But it was really like, the wisdom of the 1,000 people that I talked to throughout my career as a CEO fell apart.
Okay, great. A couple of specific questions for you. What was your experience like with the provincial regulators through the process? I'm sure that's going to be interesting. And out of curiosity, did you have a disruption plan when you started the business initially?
Sorry, I'm not sure what that means. Are you able to clarify that?
Disruption service plan. Oh, sorry, go ahead.
Maybe I can clarify if I may, Maria.
Please.
Yeah. So thank you, Thea. So vis-a-vis the disruption. So what you created, I just wanted to know if you started the business to disrupt the industry, or you simply started the business to gain some sort of a market share and then sell to CI. That's what I meant by it. Thank you.
Okay. And the first question, Maria, sorry.
Your experience with the regulators.
My experience with the regulators. Okay, so the disruption question is going to be probably faster. So I'm going to answer that one. I started the business to solve a problem that I saw exist in the business. I didn't really think about it, what model that ended up was going to be. It ended up being, the sort of quote unquote disruption model, but I always sold it as transformative. We're transforming the industry as opposed to disrupting it. But it wasn't really that as intentional as it may appear in the rearview mirror. It just sometimes, at one point through all of these conversations that you have with your advisors and your board, you kind of have to make a decision as to what are you trying to achieve. But if I, had a unlimited or amount, not unlimited amount of funding, but funding from a completely independent source who just wanted to, kind of see this to a publicly traded company, that was also an option. It would just take a fair bit of time and a fair bit of resources. And on the provincial regulators front, I found them incredibly collaborative, and we brought something to them that was never existed in Canada. It went straight to enforcement. It skipped everything else, and I got a call from Enforcer in November of 2012, and it was very polite, and they just asked me to come in. And I hadn't really broken any regulation at that point because we weren't registered, but they told us that we had to tell people that we weren't registered. So, but at that point we started a conversation about what we were trying to do, and they laid a plan for us about what we needed to do in order to get them to allow us to continue completely independently of like a bigger company. And so a few months later, we submitted our submission, and then they invited us for a demo. So they called us on a Friday and asked us to come the following Monday, so like 10 days later, and demo our technology to the team as a data point in the part of their registration process. Well, we hadn't actually built the technology because we didn't know if they were going to approve us. So we didn't have the technology to demo. So my CTO literally faked it. We built a workflow, because let's face it, they're not going to go into our stack and find out how scalable it is and how security proof it. They just wanted to see the workflow and what we were in front of the clients. And we demoed this god awful pink user flow. I don't even know why we picked that color. And we went to the Securities Commission, and 25 of them showed up. It was the biggest boardroom. I was really scared. And then at the beginning of the meeting, I remember the CEO saying, please don't be scared. Everybody's just really excited. And so we had a big 4-hour meeting, the demo, because all these 25 people now have to all ask us their questions. And then from that point on, it took another 4 or 5 months before they finally approved us. Simple coming on our coattails didn't help, because that complicated the multi-jurisdictional zoning and the fact that they were in Ontario, and we tried to blanket Canada somewhat faster, and so caused a bunch of problems. And so that delayed us because it got deferred to BC, and the Ontario Securities Commission, in an unprecedented way, deferred a complete decision to BC Securities Commission, because by the time Wealthsimple came on to them with the OSC, we had already almost gotten approval. And so they deferred the decision. We jointly got due diligence got completed jointly on summer of 2014. And in August, we were granted our 3 jurisdictions that we requested, which was BC, Alberta, and Ontario. And they were granted Ontario and BC just because the BC was kind of spearheading it. And that was August 20th, 2014. It became the day, the birthday of robo-advisors in Canada.
Wow, that's great. Good story there, for sure. And then maybe finally, Keith, anything you would do differently? And was there sort of one key decision that you decision not to do that made a big difference to the deal?
Yeah, I think I mean, Nero as a company had gone through 2 previously failed acquisitions that didn't happen for numerous reasons, and I think it's there's always something that has the potential of killing a deal, and so I think I just goes back to my previous comments around strong deal team. And it's not just having part of the deal team is having the ability to play good cop, bad cop. And that's again what we had between my chairman and I, because we the management team and I were going over to the new company. We needed to be in good with the new company, and so I couldn't hammer them on compensation agreements from our executive team or little minor points, because I just well. So I think learnings for me is just having that ability to have someone take the brunt of the bad stuff and play the bad cop is really important versus not having that. I think that was critical. I've seen that. I think the couple of the previous deals that didn't go through had a lot of that resentment towards the end of it, just because we're both beating each other down so much that it just, the emotions carried its way. And the other I think, it just organization, just making sure that your company's organized, and that'll save you a lot of headache. I work with a couple other startups now and advising them, and the most critical things is like knowing your cap table, knowing who has options, who doesn't have options. We had a lot of people come out of the woodwork after the acquisition with Generac that, lo and behold, had options, even though they weren't on our cap table. We had no idea who they were. But they had a piece of paper that said that they were granted options. And so it was cleaning that stuff up early just saves a lot of headache.
Yep, I couldn't agree more. As an investor, these are music to my ears, and why we nag all of our companies to have a lot of these things kind of always cleaned up and ready to go. So lots of great learnings here, I think, today. So thanks so much, Taya, Keith, and Graham. I think some key takeaways, the one that we've heard over and over is be ready, get prepared, act like you're always for sale, or maybe these days even go public, or, just raise another private financing round. So be prepared, and then also have a great deal team around you during the process. And I take away a lot of good things, I think, in that in many of these cases, it was partners or entities you did know that were your acquirers, and some that came out of left field. So it's good to see a healthy M&A market that's good for all stakeholders all around. So thanks again for your time. My apologies, I didn't get the chance to cover all the questions in the chat. But with that, I will turn it back over to Team VEF.
Thanks a lot, Maria. Thanks a lot, Taya, Keith, and Graham. Wonderful conversation, and I feel like we could have continued this on the Q&A for a long while. Luckily, there is the breakout rooms, which I think Nicola will push people to if they want to continue the conversation. Again, so thank you for joining this event. You're going to get a survey in your email that will be emailed to you. Want to provide the best experience possible, so we're looking forward to hearing everyone's feedback. And I'm also really excited to announce the next of VEF event that's taking place in February. On February 23rd, it's a very special event. We invite you to join VEF and Deloitte's Duncan Stewart, co-author of Deloitte's annual Global TMT Predictions Report, as he provides an in-depth look at the trends set to affect and disrupt your business. So you can preview the report online, and we'll include a link to it in the Zoom chat for you to check out. And so next month, expect an engaging presentation from Duncan Stewart, plus lots of time for questions on the future of technology. Registration will open up later this week, and we hope you'll join VEF and Deloitte for this not to be missed event. For those of you who want to continue the conversation this evening, we're going to move everyone into the breakout rooms for the remainder of the event for virtual networking. Our board members, some of our panelists will be in the rooms to facilitate networking, to take part in the discussion. Make sure to introduce yourself, make sure to connect with people in the local tech ecosystem. For those of you who can't stick around and network, again, thank you for joining us this afternoon and this evening. It's great to see everyone online, and it's great that we can connect and network in this way still during these crazy, crazy times. Again, thanks for joining us. Hope to see you in February for the next forum. And for those of you who can stick around and network in the breaker rooms, looking forward to chatting with you there. Again, thanks, Maria. Thanks, Taya. Thanks, Graham. Thanks, Keith, for all of your insights and your stories. And thanks to everyone for joining us. Take care.